going to talk about returns. So returns, this is about the shareholders. Will the shareholders be happy or sad? Ne? Returns is about the shareholders. And the shareholders is going to look firstly at the ROSI. Now, let me just quickly on the back, please make sure that you understand the difference between the ROTCE and the ROSI. Okay? The ROTCE is for the loan, and it's about positive, negative gear. Right? The ROTCE is the one that's about the net profit before tax and interest expense. Over half. Can you see Tanny? It looks like a Tanny. Okay. Okay. So, net profit before tax and, oh, it must be and, interest expense. Okay, that's better. Over half. Loan plus she plus loan plus she. Okay. Times 100. And that, and please remember it, this percentage you're going to compare to the interest on loan. Okay. Because it's loan, it's loan. ROTCE, return on capital employed. What is capital employed? It's she plus loan. You guys get it? If I look at ROSI, it's about what profit of not do that. Let's say this is about your earnings. What is your earnings? It's your net profit after tax. Ne? Why do I call that your earnings? Because that's the net profit that's available to share. Okay. So, now, your ROSI is your net profit after tax. Can you see? Before tax, because I want to see if the loan generated more profit in total. After tax, because I want to know what's available. What was the company's earnings? What is earnings? What is earnings? Net profit after tax. And that is basically your dividends and your retained income. Ne? Because now, what do I divide it with? She plus she. Can you see now there's no loan? And that percentage you're going to compare to the interest on fixed deposit. Why would I do that? Because I want to see, oh, I earn 10%. If I put my money in a fixed deposit, I could have earned 20%. I'm going to sell my shares, put it in a fixed deposit. Okay? You guys get how it works? Let's go on. So if I look at the return on shareholders, returns, I'm doing the return on shareholders equity. This one, I'm going to compare, VS means versus, with the interest on fixed deposit. The other one they're going to look at is the EPS and the DPS. Why would they want to look at the EPS and the DPS? Remember, the EPS, your earnings per share, is the dividends and retained income. Right? What is your dividends per share? It's only the dividends. Okay. So all of this, we would like for it to increase. Ne? Now, with this one here, they will also ask you, what is the dividend payout policy, or rate, the dividend payout rate. And what they do then is they put the DPS on the EPS times 100, and they'll get a percentage. Can you see? And that percentage would be the dividends paid out. Okay? And the remaining, the rest, would be the retained income. Okay. So, let's say my answer is 70%. Then it means 70% was dividends, 30% is retained income. If it's 20%, it means 20% is dividends, 80% is retained income. Okay, so that's your dividend payout policy. Yes. Okay, if I do my appropriation T account, I must start, can I move it up now? I want to work here. Okay, so if I look here, I must have my net profit before tax. Then I deduct my tax. Now the moment I say net profit before tax less tax, it gives me my earnings. Okay, so that's what I have available to pay out to my shareholders. So some of it I'm going to pay out as dividends, and some of it I'm going to retain for the business. Remember, what's retained income? It's my savings. It's the reserves. The company needs reserves. So dividends and retained income is equal to earnings. So in other words, your EPS is your net profit after tax over shares, and your DPS is your dividends over shares. Now there can also be situations where they also use the old retained income to make their earnings a bit more. Then you'll see your retained income is going to decrease because they're using it. Dividends. Okay. So with this one, also easy to comment on. If the percentage dividends increases, it will be because you want to make your shareholders happy. Next, if you pay out a bigger percentage dividends, is you want to keep your shareholders happy. Okay? If your percentage retained income increases, it's because you're expanding. Does that make sense? Mm-hmm. So in other words, both situations is good. Not one of them is bad, depending what type of shareholder you are. Some shareholders would be happy if the dividends are more because they're in it for the dividends. Other shareholders would be happy if the retained income is more because they're in it for the investment. And what does it mean if the retained income is more? It means the value of your share goes up. Why does the value of your share go up? Now let's talk about shares. Keep that question in your head. Why would I be happy if the retained income increases? Because the value of my share goes up, and I want to sell my share. Okay, now let's quickly look at this one. When they talk about shares, Okay? When they talk about shares, you're always going to quote three prices. You're going to quote either the issue price or the repurchase price, depending on the scenario. You're going to quote the market price, which is the JSE price. And you're going to quote the NAV. What is the NAV? Net asset value. That is the intrinsic, in other words, the value of the share in the company. Okay. And you always want all three of them to be on par with each other. Okay. Now remember what I said, if your retained income increases, it means the value of your share increase. Why do I say that? Because your NAV is shareholders' equity over shares. What is shareholders' equity? Ordinary share capital and retained income. So if the retained income becomes more while the shares stay the same, it means your NAV is going to go up. You see? The asset value of your share will go up, which is always good. Okay. So this is basically the spectrum. And then, of course, there's majority shareholding, which we've done already. But that's not really ratios, but it will form part of this question 3. Okay. So I want to work through examples with you that you can see how we do it.